Hi, everyone. It's Grant Abbott speaking, and welcome to my top five SMSF strategies for 2021. It's the 10th of November 2020, and where has this year gone? It's been absolutely crazy. I've got my wingman here, Mr. Jeff Fries. How are you, Michael?
I'm great, Grant. I'm really looking forward to today. The number one SMSF strategist in Australia, Grant Abbott, and his top five strategies. Could it get any better?
Yeah, well, I'm really going to start to pull it out, and I might throw a few little extra ones in along the way, so it's going to be a lot of fun. But life changes as we go down, and I think COVID was a huge shock to the global system. I remember we were on our roadshow around Australia in February with solar bonds, and got halfway through. COVID hit, the market dropped, everything went to absolute, sorry to use the term, crap. And listening to the WHO at that time, watching some of the Chinese videos that snuck out across the border, it was just absolutely crazy. Because if you had a look at that, you just thought it was going to end up being a disaster, that 3 out of every 100 people were going to be killed. And of course, it didn't come that way, but there's certainly been a big shock. I mean, you do a lot in the SMSF space, Michael. What are you seeing on the ground?
I'm definitely seeing a lot more interest back into it. I mean, especially there's starting to be a bit more further interest looking at property loans, LRBAs, which is good. So, and there are still a panel of lenders who are lending in that space.
What's the rates at the moment? They're pretty good, aren't they?
Yeah, they are. You can get around the just under 5%. So.
Hey, can you believe that? I remember way back in the 1980s, the interest rates on a preferred owner-occupied loan was around about 16-17%, just crazy. And you can buy this stuff through your self-managed super fund, which is it's a good thing because with that Labor government that was going to come in, they were going to knock all of this on the head, and they would have smashed SMSFs. But isn't it amazing how the boomerang turns? Hats off, big hat tip to Scott Morrison or Frydenberg, or whatever they did. I know they spent a lot of money, but what an absolute smart move to enable primarily industry funds or members of industry funds to go and pillage their superannuation. And I think we're up to around about $40 billion has been withdrawn so far. And virtually next, I think, was 250 million from self-managed super funds, which is quite disparate. At the other side of the equation is also we've got the 6-member rule, which has now passed through the Senate Select Committee. And have a go at this one. Dissenting opinion, obviously, from the Labor members of the Senate Select Committee suggested that in the future, so this is where we're going potentially with a future Labor government, is that all trustees must go through mandatory education. Can you imagine that, having to do mandatory education? Now, I know the tax office, and we had a chat with Steve Keating from the tax office in July, and they're certainly building some great educational systems. And look, I love their website. There's some really good jewels to be found there. There's some amazing little areas, but there's obviously some traps and pitfalls there. But it looks as though where we're going at the moment, that Morrison is flying high. We're lucky in Australia. We are protected by a wall of sea and ocean. But at some point in time, that has to open up. And obviously, everyone's going to be concerned about how it's going to be, but no doubt they'll have COVID tests, or people will have to have a vaccine to get in Australia or whatever. So it's going to be interesting to see how it goes. But we're obviously significantly impacted at the moment with no international tourism, lower international students, and you can just see even today, Pauline Hanson railing against the job seekers, but I think that was probably a bit untoward. Ordinarily at this present point in time, particularly up in North Queensland, and no doubt many places across Australia, that you'd have the international students or 2-year working visa people out here picking all the fruit, working in the restaurants, etc. up there. So there's a huge shortage of casual and permanent workers in these areas, notwithstanding we've got fairly high unemployment. And of course, we've got China going in and putting a ban on our range of goods because we had the temerity to actually ask, whether we should investigate the virus that came out of Wuhan. But it seems as though we're going to be the scapegoat there as well. So what happens next year? Not quite sure. Will it be as bad as 2020? Well, I don't think the virus is going to be bad. I saw Pfizer came out with a vaccine that apparently cures 90% of all COVID people. But certainly 2021 is going to be an interesting year. My prediction is that the Morrison government, we've got 3-year terms here. They were elected, I think, in April 2019. So I would expect they'll probably go around about 2021. If the economy sticks, then we're pretty well right. And certainly Morrison's riding high at the moment. So, what that's good for? That's good for SMSF, thank goodness. It doesn't mean that they're not going to make some changes. So let's move on and have a look at the new Cbus Self-Managed Super Fund. Cbus Self-Managed is an investment option that allows you greater choice and more control over how your savings are invested. So you can have a look there. You can choose from shares, exchange-traded funds, term deposits, exclusive managed investments. Cbus Self-Managed, that's fantastic, isn't it, really? The only thing is you can only have one member, which is obviously not a self-managed. Now, how they get away with advertising like this is just crazy. So again, it's a fake product there, but just shows you their envy of being able to set up self-managed super funds. I still don't know why they didn't right from the start anyway. Sorry. Before we get down, let's have a look at a few particular SMSF issues that you really need to take into account before we get into all the trustees. ASIC is sticking to its guns with its ridiculous research paper saying that it takes more than 100 hours to look after a self-managed superannuation fund, and even higher in some instances, and you need to have at least $500,000 inside that fund. Now, I had an advisor come to me the other day and they were saying, well, we heard that this was law, which is clearly not the case. ASIC has been sending that information out to trustees of self-managed super funds, but really it's, I just shred it. Actually, who cares about shredding it? Shredding means there's actually information on that paper that's worthwhile. Just throw it straight in the bin. As I said before, I'd expect the 6-member SMSFs to come in from April 2021. Now, I know a lot of the industry out there are bloody hopeless, and you're all saying, or a lot of people are saying, well, why would anyone want a 6-member fund? And it all comes down to succession planning, seriously. I mean, if you have a look at it, that's the same as saying, well, we're going to set up a family trust for the family, and then when mum and dad die, we're going to wind up the trust. You don't do that. You've got to put succession in play. And that's where I see the huge weakness out of all SMSF planning, is that there is no succession. What happens when mum and dad, lose their lives or effectively effectively get dementia or divorce? We need to have these as living, breathing tools. And there's absolutely nothing wrong with having a 6-member fund, as I'll come in a little bit later on and have a look. So we need to start building our systems. I know BGL 360 is starting to upgrade their system. I'm sure Class is doing the same. So you will be able to effectively run these 6-member funds quite easily. And the best thing about that is it's liberating money from industry and retail funds over to SMSFs. So that to me is going to be a real game changer for us. Not many people think it is, but I believe it will be. ATO is cracking down on SMSF trustees and auditors. We had a bit of an expanse there, but if you've listened to the session that we did with Steve Keating, he was basically saying that the penalty provisions that the ATO has had in its offing for the last 3 or 4 years, most of them been remitted, but that is no longer going to be the case. So expect to see a lot more penalty provisions. I think it's between 13,000 and 13,400, for example, a breach of the in-house asset provisions. So there's not going to be so many non-complying funds, but certainly there will be a lot more penalties out there. And of course, the auditors are going to be the ones right in the firing line, and already starting to see it. Dealing with a lot of auditors around a lot of these particular issues. The big one is, of course, investment strategies. Look, to be brutally honest, you should have your 2021 investment strategy up and running. Basically, it'll be essentially should be up and running now because we're virtually 3 or 4 months or 5 months into the year. Our 2020 should have been done years ago. Remember, investment strategy is a forward-looking document. I must admit, I was a bit surprised in February 2020. I think COVID sort of wiped that all out. But your investment strategy needs to cover, for example, if there's options, it must cover in there a derivative statement. If you've got reserves, you need to have in place a prudential management statement for all members of the fund. Your requirement to note their names, their ages, their retirement objectives, and also the insurance the fund has on it, whether it's considered or not. If there's borrowing, we've got to have a look at what the borrowing ratio is in there, and look at all the major asset classes from domestic cash, international cash, domestic equities, international equities, domestic fixed interest, international fixed interest, domestic property, international property, and of course there's a whole lot of alternatives. We could have obviously futures, options where you need that derivative statement. You could have gold in there. And certainly we've done a lot of work at the Lightyear Docs investment strategy. If you haven't had a look at that, I'll send one out to you with this session so you can have a really good look at it. Anyway, let's get away from that. Okay, succession planning is absolutely crucial. If you have a look at this little thing, so we're moving towards the death of a person or dementia. We need to build our funds with longevity in mind. And given the fact that the rule against perpetuities doesn't apply to this trust, because effectively an SMSF is a trust, then we really need to start to build in that succession planning, which is ideal, bringing the younger members of the family in, and not only one generation, but two generation. Some of you may have seen me when I've done my some of my case studies. I use the story of John and Sally Smith, their son Max, two children, Ben and William, who are the grandchildren of John and Sally. Well, they're prime people to come in as members. At what age? Here's a good question. At what age can you be a member of a self-managed super fund? What's the legal requirements? What is the case law around ages of members? Well, you'd be very surprised. You can actually be a member of the fund as soon as you are born. Of course, it's not a bad TPB. You'll have a 1.6 million transfer pension balance to start and accumulate, but effectively you can be in there right from the start. Now, when we come around to succession planning, if we start on the right, and you would have seen me over the last, certainly probably about 7 or 8 months, move solidly into that succession, asset protection and estate planning space, which of course self-managed super funds are an important part of the equation, but so too are family protection trusts, discretionary trusts, leading member trusts, and of course wills with testamentary trusts, etc. Now you can see that dotted line coming down here. Effectively there, we've got our wills, which we might be able to build in there that have specific bequests, residual estates. You can actually make distributions or contributions into an SMSF. You can establish a testamentary trust. If it's solely with super that's come over from the SMSF, then it's a superannuation proceeds trust, which is quite separate. The only issue about that is as soon as we pass that red line, so if we take our super from our superannuation fund, which is guided and governed by the Superannuation Industry Supervision Act, which is a federal or Commonwealth government law, as soon as it moves over that red line, it now gets caught up in various state-based laws. For example, the New South Wales Succession Act. And that means that then under Part 3 of that Act, any eligible person, such as a child, a spouse, de facto, anyone, even grandchildren who are financially or partially financially dependent on the deceased, can claim or can mount an action as a family provisions challenge. Whereas if we go back on the other side, if we look at our succession planning, our SMSF, they're not subject to family provisions challenge. There's only been one in New South Wales, that's under the notional estate concept, which I saw in Kelly versus DeLucci. I don't believe that they should have really argued the constitutional side there. But any other state, once we have benefits being paid directly out of our superannuation fund, it's not subject to a family provisions challenge. And that can be absolutely crucial. For example, we might have a pension document there with a reversionary pension. In fact, with a reversionary pension, we can have a reversionary pension that goes, for example, John to Sally. Remember that one I talked about a little bit a while ago? We've got John, Sally, Max the son, and then we've got 2 children, Ben and William. We can have a reversionary pension that goes from John, then to Sally, and then to Ben and William to share jointly. So let me say that again. I can write up, using the Lightyear Docs system, a reversionary pension that goes from John to Sally, and then effectively goes to Ben and William as joint owners. Now, of course, if one of them dies, it passes over to the other one. Now, in order to do that, what I need to show is, first off, if Sally is a dependent and William and Ben dependents of John at the time of his death. Then in that instance, Sally is automatically included. For dependency purposes, we need to show that Ben and William were being supported by John. And that may well be by way of school fees. In fact, there was a fantastic private binding ruling that I obtained last year from the tax office, where the payment of university fees, school fees, etc., are to be treated as financial dependency. Now, the benefit about that, let's have a think about it. We could go from John to Sally and then to the grandchildren. Now, if John was in receipt of the pension, then it means that Sally, when she receives a pension, will be tax-free in her hands. And if he's over 60, it'll be tax-free in his hands. Likewise, when Ben and William receive the pension, it will also be tax-free in their hands. As grandchildren, will be tested against their TPB, but obviously they're going to be very young. They're going to be under 18, so they've got plenty of capacity in TPB. And that's one of the benefits of this system, is that we can use group TPBs, group concessional, group non-concessional contributions. It's absolutely crucial. Getting back to the reversionary pension, once I start that reversionary pension, it takes it out of all estate planning, takes it out of family provisions claims. So reversionary pensions are my number one go-to, provided, of course, you've met that condition of release and able to set it up. Now, mind you also, we could also have going from John to Sally and then also to Max. So if it goes to Max, Max is an adult child, not a dependent for SIS purposes. And we could potentially, if Max was a dependent, when we had a look at financial dependencies, it's going to depend on obviously the facts of the case. But importantly from that, Max will not be able to receive the ongoing pension because he's over 25 years of age. So that means that SIS regulation 621(2) would not allow that to happen. However, if a pension went to Ben and William, because they're not children, or they're not the children of John and Sally, but they're financially dependent, then there is no such preclusion of paying a pension, an ongoing account-based pension, to both Ben and William as a joint pension. So that seems to me to be a really exciting opportunity. It gets around family provisions. It has built-in succession. Ben and William will become members at the time they receive the pension. Alternatively, why not make them members now? They don't have to have a huge amount, but why not put that in there? Some of us don't have reversionary pensions in place. I dealt with a client the other day through Abbott Morley. They had a basic reversionary pension, but they wanted to build the multi-generational reversionary pension that I was just talking about. So that required a rollback to accumulation. You just got to be careful if there's a lot of, if you've got tax-free components in your pension side and taxable in your accumulation side, then we need to work around that one. But please feel free to contact myself or Michael. We're there to help you. So that if we do that, we can roll back and then we can recommence and create a brand new account-based pension with a multi-reversion on it. Of course, we can also take that commutation from the adult child. Remember, we were talking about Max. What we can do is we can take that that amount that goes to Max. It's a commutation amount. Remember, he can't take it past age 25 because he's a child. Then that can go into what we call an SMSF Death Benefits Trust, which is effectively an SMSF testamentary trust that I'll talk about a little bit later on. Phil Scandizo, really good question. Can Ben and William continue to receive a reversionary pension if and when they turn 25? Absolutely, because the law basically says that if you're a dependent, and let's say that we meet the rules of a financial dependent here, if we're a dependent, then effectively what's going to happen down the track is that if we are a child of the pension member, so that's John, then we are precluded from receiving that reversionary pension if we're over age 25. So it would mean if we made Max there, of course it could be commuted, and then what could happen is Max could take up that SMSF Death Benefits Trust. But by having those children, Phil, what happens there is they're grandchildren, they're not children. So that lockout law for children doesn't apply. So Ben and William can continue to receive that reversionary pension well and truly beyond 25 to age 45, to age 65, to age 75. It just depends on what size or what remains in that account balance at any time. And the best thing about it, you know, Phil, when they receive that money is completely non-preserved, so they can take it out at any point in time. Now, of course, when you're writing this, we've just got to be careful. And if you have a look at our auto reversionaries built into the Lightyear Doc system, what I've done there is that if they are under age 25 or 30, it depends on what your client wants in terms of their requirements for their grandchildren per se, that in that essence, we can put down conditions. For example, it's non-commutable up to age 25 or 30, so they can't take a lump sum. And then we might limit the pension up to a certain amount. Of course, Ben and William, if it's in play, once they turn 18, it is actually their pension. It's their income stream, which is why there is no family provisions challenge, because once we set up a reversion pension, it now falls outside of their estate. If we then go back to the accumulation side, so if we haven't yet got to our condition of release, so we're just receiving retirement income, also retirement monies, we've got our accumulation, we've got a BDBN versus an SMSF will. I did a big session on this a couple of weeks ago, and I'll send you links to that session if you haven't had a look at it. But BDBNs are generally extremely weak. Look, I've seen Dan Butler spend hours berating, if you have a look at all the legal cases around BDBNs, unless they're absolutely super tied in with the governing rules of the fund, the trustee, they can all fall foul, they can all fall to pieces. Whereas what we have is an SMSF will, which is just a set of binding directions, enables reversionary pensions payable to the SMSF Death Benefits Trust or the SMSF Testamentary Trust. You can pay out lump sums. So there's a whole there's a whole range of elements that you can create. Here's a little one on death. If we want to do a recontribution strategy, and we've got underlying assets in the fund for which we cannot, we don't want to move, for example, it might be a farm or a property, what we can do is obviously pay out as a death benefit, importantly, a promissory note, which again you can find up on our site, and that promissory note can then be recontributed back into the system. You can't do book entries, but promissory notes are cash. Take it out and then effectively put it back in. So by putting it in, extinguishes the promissory note, which is a note to pay a benefit from the trustee of the fund down to the beneficiary. So again, that's our little recontribution or washing strategy. And it's not a bad idea, to be able to do that for a whole lot of our members. And again, if we start doing those sort of things, we don't have that family provisions challenge. So for example, if I had a SMSF will, all of my super effectively was to be paid to Max. I've got two daughters, or John and Sally got two daughters, Jessica and also Sarah, all goes to Max. He sets it up to an SMSF Death Benefits Trust, which is a testamentary trust for his children. Then effectively they cannot make a claim as against that. But of course, the trustee needs to make sure that they're minding the wishes of the client as well. I have seen that Victorian case where they replaced the trustee, but again, I think that was a bit of an outlier, that case. Certainly, none of these cases, for example, Kelly versus DeLucci, anyone is actually going to look at the Constitution because effectively states do not have constitutional impact over superannuation, which is fairly important. So succession planning, I love SMSF style. You can see there, Phil, I talked about not only 1, 2, but 3 generations. It would be so much easier if they're inside the same fund. Okay, superannuation access. That's the big one for a lot of our clients. Now, it's been hugely beneficial. And remember, up to the 31st of December this year, we can pull out another $10,000, or clients can pull out another $10,000 from their super. So I expect to see a huge flurry in December for that. And no doubt the industry funds will close down all their operations probably from about the 20th of December. And I would say that there'll be huge issues going to AFCA, which now holds a super complaints tribunal. They're trying to stop the bleeding, obviously. For obviously for our funds, SMSFs, as I said, only $250 million has been taken. So, that COVID release has been pretty useful. Concessional catch-ups are pretty useful, but, once you get to that $500,000 super balance, effectively you're sort of up against it. Now, that means if we have a look at it, if we've got a discretionary trust and we've got Ben and William, the kids, are operating or actually employed by that discretionary trust, they can make contributions into super, and they'll also be able to do your concessional catch-up as well. Now, mind you, they're very young, but that's still not a bad thing. Good way to get money in super. And remember, it's being distributed down to them. Now, that's as an employee. So you'll find that if they're an employee, it's employment income that is not accepted. That's accepted trust income. So effectively, it's not going to be taxed at the highest marginal rates. So get those young kids working, and more importantly, if they're working, you'll find that there's a couple of cases, also ATO ruling on this, that effectively there is no limit as to what contributions you can pay. So given it's a concessional, you might not want to go above the cap. I'll talk about it later, particularly if you've got younger members in that system. So if your clients have got tax problems this year, then effectively start utilising all the family, put them all in the fund, and then get them employed by that discretionary trust. Non-concessional caps, problem about that is if you don't use it, you lose it. So each year we've got $100,000. If we've got a 6-member fund, that's $600,000 we can put in, provided they haven't met their general concessional or their general transfer balance or the general superannuation balance. So make sure you put it in. If you don't, as I said, you lose it. You can obviously do the 3-year bring forward as we see fit, and no doubt non-concessional will drop off later on. So a great strategy really is to use NCC and also loans. If you've got clients who are effectively transferring properties into, if they're making contributions of property into super, just be very careful. My great belief is that if you've got clients who are going to be making NCCs, probably cut back on the NCC. And if it's going to go into property or shares, do it a mix of NCC and also related party loans. Use the Commissioner's Guideline, PCG 2016/5. So the way that would work effectively, let's say a client's got a couple $100,000 that's been gifted by their parents or a family trust or so on and so forth, then effectively what we do is we're going to put that into super. The client is 40 years of age. Obviously, if they put that all as an NCC, they'll have to use the bring forward, which is fine if they've got that capacity, but they won't be able to touch that money until they're age 67 or 68. Now, the issue around that one, effectively, they could use that money, obviously not to go and buy property, or they can use that as part for property purchase within the superannuation fund. Main thing you've got to watch out for, though, is potentially it might be better to use ETFs. So if, for example, if you used a Vanguard or State Street ETF, put the whole $200,000 in, then what we'd do is $100,000 is going to be non-concessional. The other $100,000 is going to be a related party loan under 2016/5, which means we need to have superannuation trustee documents, holding trust. We need to have holding trustee minutes as well, plus obviously a mortgage deed and a related party loan. And I think this at the moment, the current rate on PCG 2016/5 under the safe harbour is 5.1%, which is certainly, in fact, I think it's 7.1%, I forgot, for shares and units, 5.1% for property. So if we do that, we put it all into the ETFs, then we've only got one collection. So it works out really well. And if a client wants to withdraw money at any point in time, they've got that related party loan. And if they withdrew it pretty quickly, they'll obviously be able to take that $100,000 out. But what is required, obviously, with PCG 2016/5 is a repayment of P&I over a period of 7 years if it's an ETF, which is not too bad. But remember, the first year is going to be mainly interest and certainly not principal. So they can withdraw that at any point in time. So it's certainly useful to have that related party loan at call for family use. So one of my strategies is if someone wants to put money in, look at it straight off for the related party loan and then come back. I saw an article in the SMSF Advisor the other day as to effectively related party loans. The PCG 2016/5 was basically too expensive, all too hard, and it's not worth doing. Well, on our certainly on our platform, if you're one of our subscribers or our licensees under Light Year Docs, you can do as many as you want. So if you want to charge a client $300, $400, $500 to do that, then you can do so. If it's $2,000 or $3,000, absolutely. But you can do that because your underlying costs are virtually negligible. It's what the client does come to you. I think that's the big thing about Light Year Docs is we're there. Our mission statement is to set you up with strategy, set you up with automation, set you up with documents in order for you to make money rather than the lawyers. Okay, strategy number 2, tax grouping. The concessional caps are a joke, absolutely, if you look at them as an individual. So if I'm in an industry fund, I can put in $25,000, but at the end of the day, it's a bit of a problem around that. And of course, in our mind, we have that you don't want to go above the caps, which up to 2013 was the case, because if we went above the caps, we're subject to a penalty tax rate of 31.5%. So this was pre-NDIS. So essentially what we want to do is the Smith Discretionary Trust, have a look at this. We've got leading member and Dr. Matt Smith. So this is not Max, who's age 40, distributes to dad, who's 64, John and Sally. You can see there. Then they can distribute to John and Sally or alternatively employ them. But if they distribute to John and Sally can then contribute that $75,000 each into the system and claim a personal tax deduction for them under section 290(1)60. So that's crucial. So by distributing from the discretionary trust, we've effectively, and just listen to me here because I'm going to give you a couple of really good twists. By distributing to John and Sally, they're putting the money back inside the self-managed superannuation fund. That could go into their accumulation stage. If John's already in receipt of a pension, he can roll back, aggregate it, and then start the pension again. It's not too bad. I mean, if you roll back and start it again, obviously you just have to watch out for your transfer balance, which is pretty important. Just as another sidebar here, I said this at the start of the year. Look, I don't know where the market's going, but what I would strongly suggest is that all you may want to put in place, and certainly we've got an option with the account-based pension coming up in the Light Year Docs system, that if there's a fall of 10% or more, the member may easily commute that pension, or there can be a deemed commutation. The reason we say that, if the market drops down 30 or 40%, then essentially if we commute, our transfer balance goes back as a credit to whatever we commute, goes back as a credit to our transfer balance. So it's a really good little strategy, just something as a bit of an insurance strategy. And what I mean by that, a TPB insurance strategy for next year in case the market has a tanking. But again, don't listen to me. I thought it would have tanked early this year, but it's going great guns at the moment. Now, when we go through and we have a look at John and Sally, they've received that $75,000. John and Sally are both retired. Just watch out for Social Security. They've both received the $75,000. They're living off their pension income. Well, John is anyway. They're living off John's pension income. So it's all tax-free, which is a beauty. They put the $75,000 each. That would mean that it's then subject to not contributions tax, but it's including the assessable income of the SMSF. And then you've obviously got to work hard to reduce the tax liability, either using franking credits, interest expenses, so on and so forth. And I think that's absolutely crucial. From that one, then essentially what will happen from there is that the $75,000 goes into the fund. John and Sally will then lodge their returns. Obviously, they have no assessable income at that stage because they're only living off John's tax-exempt income. Now, what will happen is then the Commission of Taxation, if this was this current income year, then in roundabout when they lodge their return in April 2022, so I'm looking at almost 2 years out from here, essentially when we lodge our return, $50,000, which is the excess concessional, will be added back to John's income and also to Sally's income. We'll work out the tax payable on that, but they get a 15% tax offset. So effectively, you'll find with the low income tax offset, you'll find with the 15% tax offset that $50,000 or the original $75,000 payment in, they won't be paying any tax or excess concessional contributions tax on that. So it's a great little strategy. If you need more, contact Travis at lightyeardocs.com.au. I've got a really good worked paper on that one as well. So that's something well worthwhile looking at doing. And certainly it's much better paying it to John and Sally. And listen to this, they've both got their pension, they're living off John's pension. So each year we're putting more and more money into the family superannuation fund, the Smith Family Superannuation Fund for John and Sally, which I'm going to work on very shortly. It's not subject to Part 4A. Commissioners issued a ruling on that one. So that's fairly important. If we then go on from there, we have a look at, it's much better than having a bucket company. And so that's the strategy that would there start to use tax grouping. Of course, you can still remember we could have Ben and William employed by that discretionary trust. The only problem is Ben and William are very, very young. It's a great way to start consolidating, obviously, superannuation from a very early age. And again, this is part of that succession, but I prefer the older ones because they've got full access to it straight away. The Family Superannuation Fund, 6-member rule is coming. I know everyone freaks out that, we don't want to have more than 2 people, but then you go down the track and have family trusts for distributing to adult children. Just be very careful about that. Those adult children, that liability sitting in family trusts. We've seen a couple of cases at Abbott Morley recently where we've had some good wins on that one, where clients, children have actually sued for recovery of prior distributions. So we've got a couple of strategies around that one as well. So with the 6-member rule, we can bring everyone in. Clumsy the clumsy old way we used to look at it many years ago is we would try and keep control in mum and dad, for example, in this instance, John and Sally, if they had the most superannuation. And the way we did that is by using proportionate votes, either at the individual trustee level or up at the director level, based on account balances. It was good, it worked for a long time, but time moves on. That's the strategy I devised probably about 15 years ago. There's certainly a better one now. So you can certainly bring in younger members, but use a leading member SMSF. So a leading member SMSF has built-in succession. So what will happen with the SMSF, and it's ideal to use a corporate trustee for that one. So that's a leading member corporate trustee. What will happen there is we might have, for example, John, who is the leading member of the Smith Family SMSF. So John, as the leading member, essentially is the chairman of the board of directors and also has veto power over decision making, except for investment if you've got separate investment strategies inside that fund. So it's a good way of doing. If something happens to John, dementia or effectively potentially divorce or death, then the succession then moves down to the next person. In this instance, if I go back to if I went back here, the other one would then be Matthew Smith, if it was the discretionary trust, or Max if it was the younger one. So use your succession planning is really important. There's plenty of stuff I've got on the site for that, so just watch out for that one as well. Create separate investment strategies for the younger members, for the older members. You definitely need that one. If you don't segregate LRBAs in a larger family fund, than the equity in the LRBA. So when I mean the equity, the actual debt is then proportionally attributed to all of the fund members and is to account for their TPB. So just be really careful about that one. Whereas if you segregate, it just goes to younger members, then it's A-OK. And certainly it's the way that the Abbott Family Super Fund has been running since 1994. So I would strongly suggest that we run separate investment strategies. You'll find it on our site. It's called Member-Directed Investment Strategies, which is the legal term under the CIS Act, which enables individuals to tell the trustee of the fund as to what investments they'll have. If you've got a bucket company that's already running around there, then definitely in this instance, I would have that bucket company lending money to the self-managed superannuation fund. So get that bucket company lending money to the self-managed super fund. Again, use your PCG 2016/5 to lend it over. And then buy medical rooms, or if Matthew's got medical rooms because he's a doctor, lease that back to Matthew's business, or build new rooms, or flip houses, or buy a farm. So again, if you've got clients with quite sizable amounts of money sitting in bucket companies, think about all of these possibilities. Now, here's the big one. See down the bottom, pay a family allowance to Matthew's family by John and Sally. So we went down. Remember, have they got the money? Absolutely. So in our prior one there, what we had is we put $75,000 each, and this is ongoing up to age 75 because they are going to be working, or alternatively make sure that they work for Matthews, so they can work for Matthews business. And so as a consequence of that, they can just keep on as long as they can show they're working for 40 hours a week over a 30-day period, and that's post to age 67, then they can keep on working up to age 75 and still making contributions from there. Now, when they receive that money, if that just goes into the accumulation side, remember by that stage, John and Sally can then take that money out and pay a family allowance to Matthew's family. Now, if Matthew's a doctor, you might not be able to get him in as a financial dependent. He's certainly a dependent for CIS purposes, but tax purposes, probably not. But certainly, Ben and William, John and Sally can pay an allowance to both Ben and William to look after their school fees, their living expenses, as long as it's continuous and ongoing. And I've got plenty of information around that one. We've also got a great tax office private binding ruling. If you need that, just contact Travis will like your docs. He'll send that through to you. And importantly from that one, that family allowance, if they're held to be financially dependent, at the time there's an amount of money coming out from, say, the accumulation phase, then if they're financially dependent, it's an adult, then a contribution can be made, a distribution can be made, a lump sum can be made, and effectively what would happen there is that would come out essentially tax-free, which is important. Sorry about that, I'll just go in. So that's the family allowance. You'll find a family allowance agreement is sitting up on the Lightyear Docs site. Strategy number 4, I did a lot of work on this morning with a client. Have a look at the Commissioner's rulings and guidelines recently on property development, but certainly over the last probably 4 or 5 years, we've done at Abbott Morley a lot of advice around SMSFs entering into joint venture arrangements with related parties such as family trusts, parents, discretionary trust, bucket companies, in order to develop a property. And there's certain ways around that. You can either do it directly or you can use a 1322C trust. In fact, many of the strategies we've done are straight out of the ATO guidelines. So just be very careful about that one. The 1322C trust is perfect. We can't have any borrowings in there or interest in other related parties. But the good thing about it is even though we've got a related entity, a 1322C trust, if it's held by a family trust or related party, and that's either the trust units, a unit trust, or it could be a 1322C company, we can transfer those over to our self-managed superannuation fund. Effectively, what happens is we've got they're exempt from Section 66, which precludes trustees from acquiring assets from members. So if you've got anything around property development, or you've got existing properties, for example, if you have a look at it, you might have a residential property. We've got money inside the family trust, or we've got the individual, and we've also got the self-managed superannuation fund. We can in fact just do a straight joint venture if we want, or we could use that 1322C trust. So effectively we could borrow if we've got equity in our own home. The individual can borrow and then acquire the units in that 1322C trust and negatively gear those units. What will happen then is that those units can then be transferred over to the self-managed superannuation fund. We may be able to gear those units. It's a little bit problematic because we have to look at it very carefully under NALI, as opposed to the safeguard provisions under 2016/5, which is only applicable to investments which are listed. So 1322C trust is good, but JVs are also good. Of course, you know, I love the syndicated unit trust. If no one holds 50%, perfect. So if you and I want to go and do a property development, absolutely crucial. But as we go down the track, particularly when we start to build up these 6-member funds, we're going to see more and more farms. We're going to see more and more commercial properties, more and more residential properties. We're going to see flips. We're going to see renos. The younger brigade, as Michael said, is seeing a lot more interest. They're going to come in and start to look at that property side, the Dan Block effect. That's what I call it. Okay, so this one, I've just put this in as a plug. If you haven't seen me do this, use the moat. Absolutely crucial. So this is the first time ever. We've got a bigger one than this, but this is what we call a comprehensive estate planning package. It's available up on our system. Again, there's no extra cost for our strategists and licensees. Use this for every client. But essentially what we've got there is we can use a client. You can see there's a protector. I don't want to go into the protector to any great extent. Effectively what it does though is it pulls our equity. It's a transfer of, not equities, transfer of equity or net wealth that's residing in our family home, investment properties. Anything in our own name can be transferred over to a family protection trust using that protector. Very, very, very popular strategy. Most advisors are charging $4,000 to $5,000 for that. If you need comms, if you need further on that, we've got plenty of stuff. Again, just contact Travis. It's not the subject of this discussion. Enduring powers of attorney, absolutely crucial. You'll find in our EPOA, we've also got successor directors, so that on death, your EPOA it will be automatically appointed as a director, or in the event of dementia, can be appointed as successor director of your trustee companies. And we're looking there for both your SMSF corporate trustee. And if you're using a leading member, what happens on death, dementia, divorce, or bankruptcy, effectively your shares in that leading member trustee company, SMSF trustee company, are effectively cancelled and the new shares issued to the next leading member. Remember that case of Matt, who's going to be there. Of course, you can then upgrade your SMSF. You can either start one up, or you can see down here under the SMSF section, you can upgrade your constitution very easily to a leading member, upgrade the SMSFD, do an SMSF will, doing all that stuff that we talked about before, and then you can do a last will and testament. We're doing an estate planning section next week, or a deep dive, estate planning 101, which will talk about how accountants and financial planners can do wills, EPOAs, testamentary trusts, and do it all legally within the bounds of the law. Okay, so SMSF testamentary trust versus super proceeds trust. So if we've got money in our accumulation phase, or the pension has ceased and there's no reversion, then we've got a choice of either paying out to the legal estate or paying it out to a dependent. That's just simply what's described in section 62, the sole purpose test. On death, it goes to a dependent, or alternatively goes over to the estate. Now, both of them, we could set up a SMSF testamentary trust. I call it an SMSF death benefits trust, but effectively it's a testamentary trust that is established by the trustee of the estate, whereas the super proceeds trust is completed by the executor, and that's quite different. Just going back, I think if I've got back here, importantly, when we do this, we do make transfers out of here. The wills, we can't actually make transfers of property, etc., until we get probate, which can take anywhere from 3 months to potentially a year or more if it's a contested under a family provisions challenge. Whereas with the SMSF, we can start paying out benefits. Well, for pensions, we don't have to. The pensions just continue straight away. But if we're paying out to a SMSF death benefits trust or a lump sum or creating a pension, they can be done straight away. In fact, I highly recommend they're done by you as the advisor well and truly before probate. So when we have a look down there, the super proceeds trust completed by the executor, but the bad thing about that is it is actually sitting on the will side. So therefore it's subject to a family provisions claim. SMSF testamentary trust is not subject to a family provisions claim. So that's absolutely crucial. There might be a bit of notional estate only in New South Wales only, but certainly we've got structures and strategies around that one. One of the major issues, though, as you can see here, the third bullet point, the SMSF testamentary trust can only be for dependents. So we need to show those interpersonal relationships or interpersonal financial dependency, financial dependence. Remember those family allowances we're talking about. Child and spouses are automatically included. So, for example, Matt there, who's our doctor, we could pay death benefits out directly to Matt. It would be hard though with that family, family allowance to probably not be treated as a financial dependent. So we might be up for tax on there, but effectively it goes into a testamentary trust for Max, but it's also protected. All of our trusts, our SMSF testamentary trust, our family protection trust, our leading member trust, and also our SMSF wills are all geared towards ensuring that benefits are only payable to bloodline. So let me say that again. They're all ensuring that benefits are only payable to bloodline. So hence, quite often, spouses of dependents or lineage are excluded from all of these transactions. So the super proceeds trust effectively is for non-dependents. So if you do have non-dependents, then you can pass it over to the will for them, set up a super proceeds trust, and I'll show you how to do that in our estate planning next week, 101. The only issue about that is subject to a family provisions claim. And you can't set up a trust in the will until someone dies, probate's been granted, because you can't set up a trust until it's settled. So a family provisions claim can cease or stop a super proceeds trust from running for a while. One of the big ones there is also the super proceeds trust. There's been recent anti-avoidance rules about transferring monies or other assets into a testamentary trust, which has been a common strategy, but the super proceeds trust, which is part of that, is now subject to those testamentary trust anti-avoidance rules. But the SMSF testamentary trust is not at this stage. So certainly there's a bit of a benefit there. I'm a great fan of the SMSF testamentary trust, which I call a death benefits trust. Now watch your tax and also watch out for your structuring as well. Okay, so we're almost at the end of the hour. Let's just go through to a few things. I've obviously made the move. I know Michael has as well, and many of our advisors have started moving over to the succession, asset protection, and estate planning space. Now, I've been talking a lot about that. The SMSF is a fantastic asset protection vehicle and also estate planning vehicle, but if it's got no succession, it's absolute rubbish. Can you imagine how many 1 and 2 member funds are going to be dead and buried within the next 20 or 30 years because we have no succession planning in there? And that is just absolutely crazy, particularly when children have got sizable balances sitting in industry and retail funds. It's almost criminal. So succession, asset protection, estate planning, the protector, we've got a whole lot of other stuff on our site for that one. So make sure you come to our session next week. You can see the bottom one. It's next Tuesday, I believe, but I'll send you out information, or Travis will, for our estate planning 101, which is a 2-hour session. We go through a whole lot of case studies, look at capital protected trust, testamentary trust, SMSF death benefits trust, how to do a will, and again, how accountants and also financial planners can give succession, asset protection, estate planning advice legally. We've got quite a few things coming out. Make sure you also, if you've got the time, tune in on Thursday. If you've got the time, essentially to tune in, where I've got a new data capture for wills, testamentary trust, EPOAs, and also SMSF wills. So I'll go through that, show you how it's very easy to then get that inputted into the system, and then you're off and running. You'll be able to do wills and testamentary trust for clients, EPOAs, successor directors, and also SMSF wills, which is fantastic. Now, I've talked about a lot of our structures and strategies. If you haven't seen our system yet, you'd like to go over the moat or do whatever, please feel free just to contact Travis. He's given his details up there. If you'd like to have a demo through the system, please feel free to do so. You get a whole hour with me. In fact, I've done a couple recently because we're getting so big in terms of the documentation strategies. They've gone to hour and a half. But during that session, have your staff on or whoever's making, whoever's the advisors in the team, and come with a whole lot of SMSF questions or strategies or answers. It's a great opportunity to get one-on-one with me. And if not, if you'd like to have a focus around trusts, tax, and also companies, make a session with Michael Jeffries. Just contact Travis, and more than happy to spend some time with you, particularly as we lead up to December. And we've got up to December, we've got a bit more time. And of course, Michael has put up there, we've got a great session again tomorrow. All of our sessions have 1 hour of CPD and also CPE. Tomorrow's session is going to be on asset protection and pre-insolvency with myself and Michael Jeffries. We're going to look at some great strategies around that. That to me, probably, I've given where I'd focus in on 2021, that 6-member rule, making multi-generational, grouping, non-concessional, grouping concessional, doing family allowances, starting to really build family estate plans in SMSFs. Tomorrow, though, obviously, once that water runs out, that job keeper, we're going to see how many businesses are actually going to stay afloat. So you must tune in tomorrow for that pre-insolvency issue with Michael, and of course myself on that data capture for wills, testamentary trust, EPOAs, and also SMSF wills. Anyway, it's Grant Abbott signing off. I'll be sending out this recording a little bit later on today, but thank you very much for your time today. It's Grant Abbott, Michael Jeffries, and everyone else signing off.